Thanks, Carol. It's lovely to be here. Thank you for inviting me. I'm sorry I only caught the end of Jeremy's session. It sounded like it was really interesting, and I hope there won't be too much overlap, and also that this won't be too basic, because I thought it might be helpful to just kind of walk through the role of green finance within climate initially, and then we can sort of drill down into some of the barriers to it and some of the solutions out there at the moment. And then specifically, I wanted to sort of share some of my thinking around nature-based solutions and adaptation. My role at the Institute is I'm Director of Nature Programs and GFI Hive. So I'm going to share which is, I'll talk about in a second. Let me just share my screen with you. So there we go. So I'll see if I can do this slide show. Right, so hopefully that is working for you and not too big on your screen. So let me see if I can move pages. Oh, this is nifty. It's coming up in so yeah, I'm Director of Nature Programs and of GFI Hive. We just launched GFI Hive last week. It's like a knowledge sharing center around private finance specifically for nature, which has kind of come into its own this year, and we'll talk about why nature has suddenly made it onto the climate agenda. So just really briefly about us, because I might have told you this before, perhaps, I don't know, but we were set up in 2019 following a recommendation made to the UK government, and we're actually seeded by UK government, although we act independently of UK government, and we do have other philanthropic funders. And our role is to work with the private sector, the finance sector and the public sector to understand why finance isn't flowing into net zero solutions and nature positive solutions more recently. So while there is sort of this wall of money, as we keep hearing, it's not moving, and we wanted to understand why. So essentially what we do is we put together coalitions of all different stakeholders, whether it's academia, local government, national government, finance sector, private sector, NGOs, civil society, and bring them together around things like decarbonisation of buildings and decarbonisation of road transport. They're the two biggest things we need to decarbonise in the UK and also in the States. And I would think across most of the world, actually. And we say, why isn't the money flowing? What are the barriers? Let's co-create some solutions together. Those solutions may be things like developing a standard. They may also be a financial product. So that's what we do. We actually just try and get the money moving. So I wanted to just really briefly, Carol asked me just kind of give a bit of an overview of what is green finance, just in case there are so many different words that get thrown around these days. So sustainable finance is what we see as the whole. I'm sorry if it's quite a crude slide, but I was trying to sort of show the different terms out there and kind of their size and where they go. So sustainable finance is like the whole, and that sort of looks at social finance and environmental finance. So whether it's money that goes to solving social issues, like education and health, but also environmental issues. That's the broader sector called sustainable finance. Within that, there's green finance or environmental finance, as it used to be called, less so these days. And that's obviously just focusing on environmental challenges. All of climate finance is within green finance. And then climate finance is split up between mitigation finance and adaptation finance. You can see adaptation is smaller than mitigation finance. Mitigation would be finance that goes to help companies transition away from fossil fuels, for example. Adaptation is a bit trickier. It's, how do you adapt? Investing in cities, for example, to help them adapt to heat or flood. It's a lot smaller, and MBS or nature-based finance is a part of that. Nature-based finance, you can see, is quite small. That fits in the larger remit of green finance. It goes green finance, climate finance, and nature finance, and then they both kind of play in on the climate adaptation side. So I hope that's not too confusing, but you can kind of see nature-based finance is a very tiny portion of overall green finance at the moment. So this is the challenge. I'm just going to move everyone's pictures here. That $125 trillion of investment is required to transform our economy and avoid the worst physical impacts of climate change. Quite a large sum. Let's see if I can move next slide. At COP, the Glasgow Financial Alliance for Net Zero, known as GFANZ, is a group of 450 financial firms from 45 countries, and they together committed to move $130 trillion of private capital to transform the global economy for net zero. So we need 125 trillion. We've got this financial sector that's saying we're going to commit 130 trillion. We're there. They can deliver 100 trillion of finance needed over the next 3 decades, is what they're saying. The problem is, however, that money only flows where, as Jeremy just pointed out, there is revenue generation or a cost saving, or there's a risk that's forcing it to move there. So one of the criticisms of GFANZ, and it's an amazing group that Mark Carney himself has put together, is that how do you actually turn these commitments into real economy outcomes? So how do you actually get this money moving into what we need it to move? And that's really the biggest challenge that we have. It's all very well, we all like to say, well, I'll commit to spending X, or I'll commit to doing something good for the environment, but there might be a whole bunch of barriers that are in your way for doing that. And these are those for the finance sector. To get money moving into what we need to move, whether it's to fund electric vehicles or nature-based solutions like more mangroves, for example, there are policy and regulatory barriers that are currently in the way of that money moving. So there has to be a constant discussion with government and local government around some of those barriers and some changes in policy and regulation. There needs to be an incentive for the private sector and finance sector to move. As much as we like to think people will move on moral ground, it's not the way of society. We know this from just looking around us through friends and family. No matter best will in the world, in the end, convenience wins, sadly. And for the finance sector, it's returns. They need to produce returns. They've got shareholders for a start, but they've also got investors in their funds, so they need to produce returns. There's a lack of incentive at the moment. And the same for some companies. Why should they switch to a net zero transition pathway? You need to create those incentives, and we'll talk about what they are in a moment. There's a lack of pipeline coming through that sort of tests out a lot of these new innovations that we could be investing in. And the big thing is there's just a lack of revenue streams. If you invest in a mangrove forest, what do you get out of it in terms of finance? What is there a financial outcome of investing in mangroves? You might say, well, it's better for resilience, for example, but there's no sort of cash flow in there that allows for an investment. It's a real issue in some of these investments that we'll talk about later. There's a lack of capital risk. Blended finance, which means public sector funding coming in to help private funding come in, is increasing, but we still need to be more innovative about how we use that government funding. Instead of just grants, how can we use it to accelerate private investment coming in? There's a lack of standards, so investors don't know what the hell they're investing in, whether it is going to deliver what it says it's going to deliver, what is going to be the impact, are they going to end up in the newspapers down the line because something they've invested in actually turned out to be dreadful for the environment instead of the other way around. So at the moment, there's a lack of standards, there's a lack of skills and knowledge across the whole finance sector on sustainable finance. There's very little in the way of deep training happening, but also there's a lack of skills and knowledge in the environmental sector around private finance. And new legal and governance frameworks are needed. Some of the deals that we put together are all different stakeholders that never worked before, different ENGOs, different land managers, for example, landowners coming together with the finance sector. There's awful amount of governance required, frameworks required, and legal contracts. So plenty of investment barriers to investment, which is why with all these wonderful commitments from the finance sector, money's not flowing the way we want it to, not to mention that oil and gas is making money for you as an investor. So it's quite hard to get people to turn away from something when they're looking at high returns in their investment accounts. So the way we look at how do you get get through these barriers is in two ways: greening finance and financing green. So greening finance is sort of developing the supportive infrastructure that provides the incentives, but also the confidence to the investment world to get moving. So those are things like standards, regulations, metrics, ratings, and taxonomies. Financing green is where we actually work at the Institute, where we look at how do you actually create the vehicles to get the money moving. And those could be equity, ESG through ESG funds, or private equity through debt. And there's, innovative products we can talk about later, like green bonds, green loans, sustainability linked loans. And then there's blended finance, which I say is a mix of public sector funding and private sector funding, which we're seeing a fair amount of at the moment. So greening finance, just to give you a sense of, this isn't even half of what's happening at the moment. It's a really busy screen, and I was grateful to find this on a presentation that had been given by Clearstream, because it's quite hard to pull everything into one place. But there is so much happening around greening finance at the moment. There are reporting frameworks. You have the TCFD, which is companies and financial organizations will have to report on their climate-related risk. The UK has said that it's mandating that requirement. So already you can see, and New Zealand has done the same, by the way. So that will be a game changer in terms of UK firms will now have to start disclosing their climate-related risk, not only their own risk from their business, but also what their client's risk is. So that's will basically force companies to start disclosing what their climate exposure is, so that they can then start to produce transition pathways. The Task Force on Nature-related Financial Disclosures, exactly the same. A reporting framework being developed for 2023 that will say, as a company, what is your dependency on nature? If you're a water company, obviously dependent on water, what is your risk, and what is your impact? If you're a mining company, what kind of impact are you having on certain species and on the earth as you're doing mining? So once we start to sort of show, sort of get under the kimono or whatever it is you want to say, in the closet, come out of the closet, it will force companies to actually just start to behave better. That's the idea about it. And there's several, as you can see, reporting frameworks being developed. I won't go into them all. Similarly, there are lots of global goals and principles. Many stakeholders signed up to best practices and working together to develop more improved practices rather. ESG ratings and indices, several of these have developed over the last decade. And then the regulatory front, we're seeing a lot happening at the moment. The EU taxonomy, for example, UK is developing its own. There's the Sustainable Finance Disclosures Regulation. So it's quite overwhelming. If you are in the sector, it is as overwhelming to keep track of everything that's happened. You can imagine if you're a financial company right now, how terrifying this is, because you are having to put so many resources to making sure you're keeping track of all of these things that are happening. At some point, as in any market development, there will be a consolidation of the standards and reporting frameworks and the sort of groups of global goals and principles. That would be the hope. But there is a lot happening to try and push the finance sector to make better decisions about where that flow of money is going. But as I said, financing green is really important. It's often the biggest gap. There's all this lovely work that goes on in the background as infrastructure, but then the money still never makes it down onto the ground, into the electric buses and solar powered houses, or trying to think, woodland projects or mangrove projects, because of those barriers that I mentioned earlier. So GFANS has, I thought it's kind of be fun to show you, has these work streams that it's working on. So remember those 450 businesses I mentioned, financial institutions working together, and they've kind of mapped this out for the next, I think it's a couple of years, what they're going to be working on. So the one I think is really interesting, possibly for this audience, is the mobilizing private capital to emerging markets and developing countries. That's number 2. So working with MDBs and development finance institutions to mobilize private capital specifically into the net zero transition for emerging markets and developing countries, which I think was a big gap that we've had, that was very clear going into COP this year, given how little, given all the countries that had signed up to the Paris Agreement hadn't fulfilled their commitment of the 100 billion a year to developing countries. So this is really now private sector has stepped in and said, you know what, private finance is going to come in and try and figure this out. Sectoral pathways is always kind of interesting. It's a way you break down some of those barriers. You sort of take a sector by sector. So you look at the fashion industry and say, hang on a minute, you use XYZ, whether it's certain, you know, just the obvious things like fur, or you might be using palm oil or inorganic cotton, for example. So how can you shift to net zero? So really focusing on a sector and coming up with solutions for them is the way that we've seen it kind of work in climate, and hopefully that will work too with nature. And there's a few more here, but it's definitely worth, if you're interested in looking at the GFAN's website, there's a lot on there, especially around what they're asking governments to do, because the private sector, as I mentioned, is hampered by local policy and regulation in some perspectives and by disincentives. And then I just thought I'd switch to talk about nature for a bit before we close and sort of have questions. Just to give you a sense, like funding for nature-based solutions for adaptation is tiny. It's 0.6 to 1.4% of total climate finance flows. In the Paris COP, adaptation sort of was mentioned briefly, but it hasn't really sort of embedded. The focus has been climate mitigation, basically carbon emission reduction. That's really where all the focus has been, and not an adaptation and resilience. I mean, forget about it. That's not even, hasn't really been on anyone's radar. I was telling Carol that someone called me recently to say that, have we thought about how you might finance for basically what happens in the aftermath when all these things we've tried to put in place haven't worked and the world is absolutely screwed and people are dying everywhere. Have we thought about how we're going to finance that? And I was like, people aren't even happy to talk about adaptation, let alone resilience, let alone post-disaster recovery. Like we're just not even, we're not there. For some reason, people haven't wanted to make this shift to think about adaptation, but you can see in the last year that has started to change. So in the last year, we've seen, for example, the TNFD, the Task Force on Nature-Related Finance Disclosures, launched. So nature started to get a bit of a seat at the table with climate. And while that's slightly different, it does sort of, it's more about companies disclosing their impact and dependencies on nature. It also just brings nature into the frame where people are starting to think more about using nature as a way of becoming resilient and helping us adapt. So that's putting trees in cities for cooling or green roofs and things like that, because, you know, the heat's, we're going to be facing some major heat crises in the decades to come if we don't move fast enough. It's about using wetlands to buffer for floods, for example. So there's so many things that nature-based solutions could support us with, including soil health, for example. But we're just not investing enough at the moment. I mean, as it says here, funds are coming in the form of grants. Private sector capital isn't coming in to nature-based solutions for adaptation. The biggest challenge is, and this is one we're trying to solve at the Institute, is how do you create revenue streams from nature that are going to support investment? So for example, I need to plant 1 million trees to sequester carbon, but also to sequester water runoff for flood and purify water nearby rivers. All these things build resilience. The problem is, who's going to pay me the money to plant the trees and maintain those trees forever? We don't. How does that happen? Well, fortunately, we have carbon credits, which means that I can basically sell carbon credits, and those revenues will pay back a loan that I might have been given to plant the trees. So automatically you've created a revenue stream for nature through the sale of carbon credits. And we have peatland credits in the UK, in the US and Australia. I'm failing, but I know there's a couple of South American countries that have soil carbon credits that they're developing as well. We're developing a soil carbon credit code in the UK that will help basically create revenue streams so that we can start to invest in nature and adaptation. A natural flood management is the same. There's a deal that just launched in the UK. It's a tiny deal, but it's really important for the UK because basically there are local authorities, a couple of insurers that are paying for natural flood management interventions made by farmers on their land. So farmers put in things called leaky dams, they plant trees that prevent the flood coming to the surrounding villages and towns, and basically those benefiting from that risk reduction in natural flood, in flood risk, will pay for those outcomes. And that allows that group to come together and then go to a bank and basically say, we've got buyers of our outcomes, but we need to pay the farmers to put in the interventions up front. But you can see all the contracts we have in place from buyers. Can we get a loan? And they'll say, yes, you can get a loan. And that way you've created a revenue stream, you've created an investment. I hope this isn't too basic, but sometimes I think we just all take it for granted that, oh, well, we should be investing in these things. When it comes down to it, who should be investing? And anyone who's investing only wants to know that they can get their money paid back at a return. So this is kind of what we're battling with right now. How do we actually monetize nature? Just wanted to, this is the final slide, just share some really interesting innovations and instruments that we see happening. Obviously there's green bonds. Last year, it's this year, we've seen more green bonds than ever before, and very large sovereign issuance as well. I believe Germany issued this year. All the years are blowing into one another, but Germany did a big deal, I believe, this year. The UK did a green sovereign bond this year too. So they are still ongoing. The question with green bonds always is that they don't fund new projects. So what's the additionality? They often, what happens with the green bond is you look back through your portfolio of loans and you issue a bond against those. So it's not new work going forward. So there's a question around its value, and often, you know, governments have to invest in the environment anyway. So does a green bond allow them to invest more? Potentially a premium that they can get, where they'll get a lower interest rate that they have to pay by issuing a green bond. But there is a sort of question about, really, are green bonds really what's getting the money moving? What I think is really interesting is the Belize Debt for Nature swap that just launched, believe around COP. It was run by the Nature Conservancy. So Belize basically was given a really steep discount on the debt that it owed internationally. It's 55 cents on the dollar was the cut, in exchange for taking the saving and investing in marine conservation. There's a couple of these deals out there, but they're really innovative, I think. Local climate bonds, retail bonds, we're seeing a lot of these in Europe. So local government can issue a bond that, you know, if you lived in that town or even outside the town, you could buy, and the money from that bond goes into investing in solar for your local area, or green roofs, or a park perhaps. And it's a really nice way of becoming, you get to invest as a retail investor, or as just a resident, and start from £5 or €5 or €50 sometimes as a minimum investment. So it's sort of really accessible, and you feel like you can buy into investing in climate change, climate mitigation adaptation. And then I won't go through every single one of these, but the one I probably want to highlight is reef credits. That's in Australia. That's where farmers are reduce the amount of nutrients, so all that input and chemicals they put on their land is washing off into the Great Barrier Reef and destroying the coral, basically. So they reduce the number of inputs onto their land in exchange for what's called a reef credit. So it's a way of sort of monetizing. You're basically getting paid to stop putting nutrients on your land. You might take a little bit of a cut in the production on your land by not using pesticides and whatnot, but you're making it up because you're being paid a credit for it, and those are called reef credits. And it's a really innovative product that we're also seeing in the UK, but that is being used now around the world. So that's it from me. I thought, by way of discussion, I have a few things here that I would love to sort of get your thoughts on. The first is, while finance is a tool to meet climate change, a change in company behavior and consumer behavior would have really enormous impact. So I'm keen to hear, do you think it's easier to force change by targeting the finance sector? Because that's kind of what we're doing at the moment. We're basically asking the finance sector to solve all of our world problems alongside government without really taking some responsibility ourselves. And I can see why we do that, but I'm just really interested in your views. Just as a practical question, like, would you be willing to accept lower returns on your pension fund or savings if you knew it was investing in climate positive actions? How low would you be prepared to go? Because I say at the moment, not everything is making money that we might like. So you can invest in oil and gas and make a hell of a lot of money in the next decade, especially as demand outstrips supply. Would you accept higher tax rates to pay? Would you accept higher tax rates to pay for adaptation in countries other than your own? I think it's an interesting question at the moment. These are sort of things we don't always think about when we go protesting outside banks about how they should change what they're doing. And I'm just interested to hear, maybe you share this with Jeremy, like, why do you think finance has been slower to move into emerging markets? And what do you think could be done? So I'll just...
all right, thanks, Helen.
Sharing. Do you want me to leave these up, Karen? No, I'll stop sharing so we can see everyone.
Okay, yeah, thanks a lot for that. That was really informative. And I think some of your slides and your points actually addressed hopefully one of Mary's questions from before, which was kind of, wanting to know about green finance at a more, I guess we can say, fundamental level. And what are we really talking about here? So we'll find out again later when Mary comes back into the panel. But I think it comes to that. Also, I wanted to say, as a matter of housekeeping, I didn't see hands popping up during Jeremy's talk, which means I must have a problem here. So, Christoph, do you see any hands coming up?
Not yet, but everybody is invited to ask some question.
Yeah, so I think the question about would you be willing to accept lower returns if you invest in something? Or if you're not investing, would you be willing to pay a bit extra tax if you know that it's going for this investment in climate change adaptation or resiliency or your future, however you look at it? So I think maybe somebody in the audience has a view on that. Would be nice to hear that now.
Oh, great.
Hey, I'll be brave.
No, don't.
Hi, my name is David Harris. I'm from the United States. I work for ThoughtWorks. We're a global software consultancy firm. We're one of our values is making positive social change and including climate change. And I'm also Carol's brother. So is that hi. So to answer your question, would I be willing to accept the lower rate of return? Yes. Only up to a certain point. So usually in retirement, I estimate that we would like to have so much money, and then based upon when I retire, how much money is that, and then what's the rate of return. You can also work backwards. How much do I have saved for retirement now? What's the rate of return that I would like to have for retirement? So within that, I would say generally yes, because I do think having a planet to live on is something worth spending on. So, but I think that the answer is going to vary widely from person to person. As a person has more resources available, the willingness to accept lower rates of return will probably be higher if they're a globally thinking person and they also value having a planet to live on. I don't know exactly what that lower rate of return is, but I would say yes. And sorry, did that answer the question?
Yeah, totally. I think it just, and I'm not saying that you will get a lower rate of return by investing in climate positive investments, but I think we have to be realistic about why so much money is going to oil and gas still. It's because it makes a lot of money. So it's sort of a question for all of us. Yes, and I totally agree with you on the resources side. Some people can afford to take a bit of a hit and others just really can't. And then the other thing I'll just throw in the mix is the rate of inflation right now is getting quite scary. You know, I mean, in some countries, it's been really, really scary for a long time. But I know in the US and certainly the UK, it's starting to get to the point where you have to make a lot of money on your returns if you're going to outpace inflation. Otherwise, you know, you're just losing money all over the place. So that's sort of adding some pressure, I think, as well. But no, that's great. Thanks for sharing that. I see a couple of other hands up. Shall I? Richard, I think you were next.
Yeah.
Yeah, thanks, Helen. Can you hear me okay?
Yeah.
Great. I guess as a consumer answering your question from a slightly different perspective, because I'm living in a number of countries in a way, but you know, I've lived and worked and grown up in Britain and now living and retired in Germany, but I've got savings in both countries. And this question about would you be willing to pay more tax or receive a lower rate of return seems to me to be a cultural question, because frankly, if you're in Germany, that's what happens. Any returns from investments are immediately taxed. 25% comes off any gains you make if you buy and sell shares. Whereas in Britain, as you know, you've got ISAs, you've got very low tax on dividends and so on. I would argue you've got basically a casino economy there run by bots that cause the stock market to go a bit like my football team back in Edinburgh. One week you're up there and the next week you're way down there, you know? And it's interesting from my perspective because I can compare both. And if you take the effect of COVID on the stock market, you know, there was this massive collapse in both countries, but very quickly Germany on a kind of gradual basis came back up and is now way beyond where it was before. There are far fewer fluctuations. So, I mean, essentially what I'm saying is that Germany, through state intervention, has a more stable stock market. There's far fewer fluctuations, but you get a smaller return. But you've got security. Whereas I think in the UK, I mean, to be clear, my shares are actually managed by my brothers who take a great interest in this, and they regularly write letters to the Chancellor about the chaos of the UK stock market and the manipulations that are going on. And there certainly are manipulations going on with share prices. This will come to the green sector, I am sure, if it's not already there. So, yeah, I'm very happy with the German system personally. I get less return, but it's a much more stable, secure kind of pension, if you like. And I know, I mean, my history in Britain and my documentary work always reminds me that what people generally prefer is security. For example, in terms of a job and so on, the important thing is security, you know? So I think if that kind of system that we have in Germany was offered, well, maybe it's not a question of being offered, it has to be voted for, I suspect, you know. People vote for other reasons, I know. How do you get Boris, for God's sake? But I think if it was introduced, I suspect people would be quite content with that sort of stable system within which I think green finance could flourish very well.
Yeah, that's really interesting. Fine. Yeah, it's funny how we just haven't valued long-term resilience as much as short-term financial gain, which is sort of the big question about green finance, isn't it? How do we sort of switch people to realizing that we need to invest in resilient futures? So I see Chumita, is that, am I saying that right? So you have your hand up.
Yes, the name is Kumisa.
Kumisa, sorry.
Yes, no, it's not a problem. I forgot to introduce myself last time. Kumisa Tengwa from Durban, representing the city of Durban known as a eThekwini municipality. So for me, I have a different take to the topic that's being discussed. I wouldn't ask the question the way it's been asked. I believe that while we are dealing with the climate emergency, we are still being, kind of very nice. And I'm hoping that in our climate action, especially with adaptation in Durban, because our adaptation efforts are focusing on the poor and the vulnerable. So it's about time where we make those tough calls and say, for example, to the private sector, big business, well, you got to where you are while you were externalizing every bad thing about your business to the environment, and the environment has sustained you so far. It's about time that you pay. Like Eskom is saying, for example, I'm going to charge you 30% now extra because I am expected to now comply with stringent environmental conditions. They thought that they were producing their electricity was cheaper because they were externalizing everything to the environment. And for me personally, I wouldn't mind paying or investing in something if I had contributed to the status quo and I was continuing to benefit from the status quo. And I'm hoping that we at some point we will stop treating adaptation as a poor cousin of mitigation, because we are here in the situation that we are because of big business, to be honest. So it's a real I don't know. I'm sorry, I don't have a straightforward answer for that discussion. But for me, my input would be that one that says, once we have built a concrete business case in terms of how much someone has benefited in the past and how much it's going to take to undo something and build some resilience into that specific ecological infrastructure that we're talking about, then it's not a choice that we need to give people. Okay, I'm talking from a perspective of someone that works in local government, where we can actually develop policies and so on and so forth and enforce them. No, I'm not saying that that's the only thing that we can do. I know that there is private sector that is actually willing to actually come to the party, but at some point, that's what you have to do. Thank you.
Thank you. Yeah, I'm totally with you. I mean, one of the reasons I put those questions in, because I just think, as to your point, it's so complex. As much as we like to think, well, we should just cost out those who produce negative externalities should be paying for them. It means that some people with those in their portfolio of their pension fund are going to take a hit. Are people prepared to do that for the sake of long-term resilience? It's such a intricate web that we're all so interconnected in. But I'm completely with you, and I'm looking forward to hearing what you're saying, and maybe we can talk at the end with Jeremy as well about how do we start getting those negative externalities priced in a way that we can start moving some finance towards adaptation, as you say, as well as mitigation. So yeah, thank you for those points, all of you. It's been great to sort of hear them.
All right, thanks, Helen. And thanks, Kumisa, also.